So let's talk about corporate debt. Is it some kind of secret weapon for making shareholders rich? Or is it more like a hidden trap just waiting to spring? It's one of the biggest questions in finance, and today we're going to unravel it. I mean, on the surface, it seems to make sense, right? A company borrows money, uses that money to make even more money, and then the owners get to watch the profits roll in. But as we all know, finance is almost never that simple. And this is the core idea we're talking about: financial leverage. It's the concept of using borrowed money, debt, as a lever to amplify your returns. It looks powerful, and believe me, it can be. But you have to remember, every lever has a pivot point, a fulcrum. And in the world of finance, that fulcrum is always risk. Okay, so let's dig into the appeal first. Why is taking on debt so incredibly tempting for a company that just wants to make its shareholders happy? Well, it really all comes down to one magic number: return on equity, or ROE for short. This is the metric that tells shareholders exactly how much profit the company is making with the money they've put in. And as it turns out, debt can be like rocket fuel for this number. Now, don't let the math here scare you. It's actually pretty simple. All this formula is really saying is that if your company can earn a higher return on its assets, that's the RONA, then the interest it has to pay on its loans, that's KD, then the more debt you take on, the higher the ROE for your shareholders will be. That gap between what you earn and what you owe, that's all extra profit for the owner. And this quote just nails it. Imagine your company is earning 10% on its projects, but your bank loan only costs you 6% in interest. That extra 4% is a pure gain for the shareholders, and they didn't have to invest a single extra penny to get it. It's profit made entirely with someone else's money. It almost feels like a free lunch. But as we all know, there is no such thing as a free lunch in finance. That awesome boost in returns, it comes with a pretty hefty side of something else: risk. A good way to think about a company's financial structure is like this Jenga tower. The equity is your solid, stable base. Every piece of debt you take on to fund your growth makes the tower taller, sure, and it looks more impressive, but it also makes the whole thing much, much more wobbly. And this is where that risk becomes very, very real. Look at this. Without debt, if your earnings swing up or down by 10%, your shareholder profits swing by that same 10%. It's predictable. But now look what happens when you add debt to the mix. That exact same 10% swing in earnings gets amplified into a massive 33% swing in profit. It's an absolute thrill when things are going great, but it is terrifying on the way down. So it's really the difference between a gentle slope and a wild roller coaster. With no debt, your fortunes just kind of rise and fall with the business. But with debt, man, the highs are higher, but the lows are absolutely gut-wrenching. That extreme volatility, that is the price you pay for using leverage. So this leaves us with a puzzle, right? Debt boosts returns, but it also boosts risk. How do these two things balance each other out? Well, this is where two Nobel Prize winners, Modigliani and Miller, had an absolutely groundbreaking idea. Now, to solve this puzzle, we just need one more piece. It's called the cost of equity, or KE. The best way to think about this is that it's the price a shareholder charges for taking on risk. It's the minimum return an investor demands. And here's the key. If you ask them to take on more risk, they are absolutely going to demand a higher potential reward in return. And here is where it all clicks into place. On the left, you've got the formula that shows how debt pumps up the shareholder's return. On the right, you have the formula for the return that shareholders demand for taking on more risk. And what Modigliani and Miller figured out was that these two things are basically mirror images. Every time debt cranks up your potential return, it also cranks up the return shareholders require by the exact same amount. This right here is the mic drop moments of their whole theory. The benefit you get from that higher profitability is perfectly, and I mean perfectly, canceled out, because shareholders now demand a higher return to compensate them for that exact increase in risk. So what's the net effect on what really matters? The actual value being created for the shareholder, something we call economic value added, or EVA. Well, the net effect is zero. Taking on debt doesn't create value, it doesn't destroy value. It just rearranges the pieces of risk and return. Now, I know what you might be thinking. Okay, that's a cool theory, but what is it actually good for in the real world? Well, it turns out this whole idea is the foundation for one of the most useful tools in all of corporate finance: See, because we can perfectly calculate how debt affects risk, we can actually work backwards. We can strip away the financing choices to isolate the pure business risk of a company. We measure this risk with something called beta. Just think of it as how volatile a company is compared to the market. And this is an unbelievably powerful tool, especially when you're trying to value a private company that doesn't even have a stock price. Here's how it works in 4 simple steps. First, you find a few public companies that are in the same business. Second, you use a formula to mathematically remove the effects of their debt. That gets you their unlevered beta. Third, you average those numbers out to get a general idea of the risk of just being in that specific industry. And finally, you take that industry risk and add back the effect of your company's specific debt level to get its own custom estimated beta. This diagram really shows the whole process perfectly. You start with the risk profiles of several similar companies. You mathematically strip out their debt to find that core industry risk, and then you add back the specific amount of debt for the company you're trying to analyze. It's a really elegant and powerful way to build a custom risk profile from scratch. So, after all that, what is the final verdict? When it comes to corporate debt and shareholder value, where do we land? Let's bring it all home. All right, let's just lay it all out one more time. Fact: debt juices up your ROE. But fact, it also adds risk and makes your profits way more volatile. Because of that new risk, shareholders demand a higher return, a higher KE. And the big insight is that the gain you get from the higher ROE is exactly perfectly canceled out by the pain of that higher KE. So the bottom line, at least in a perfect world with no taxes, is that debt is basically irrelevant to shareholder value. And this quote just sums it up so well. Yeah, with more debt, a shareholder can probably expect bigger cash flows down the road. But because those cash flows are now riskier, you have to use a higher interest rate to figure out what they're worth today. The two effects just wash out, and the present value, which is really the stock price, stays exactly the same. And you knew there was a but coming, right? This is a big one. Our entire journey here has assumed a perfect world where companies don't pay taxes. In the real world, the interest payments a company makes on its debt are tax deductible. That tax shield is a huge, real benefit. So the real question is, how does that one little detail change everything we just talked about? Well, I think we'll have to save that for another time.